A 10% property fall is nonsense. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I want to have a look at this piece from Yahoo Finance written by Michael Yardney. Property experts say a 10% house price fall is nonsense. Okay, he thinks it's nonsense. Now, I mean, that's his game, that's his business. We all know him. He's a property spruiker, property guy. But, I mean, is a 10% fall that big a deal? This is from SQM, the property capital city asking prices, guys. Now, I literally, just before I recorded this, I was on my banking app, and I saw my house prices just shot up. So they've reevaluated. They obviously haven't realized I've demolished a big chunk of it. But still, apparently, boom, all overnight, I've made more money on my house. It's a bit of a joke, really. But if we have a look here, what is the median capital city asking property price right now? $1 million. So if we went down 10%, that takes us to $100,000. How far back in time does that take us, guys? So, sorry, 100,000 down, so it's 900,000. Whoa, keep going. We're at 19. Whoop. Oh, wait, that's all houses. I want all houses. There we go. 900. There we go. So 2019. 3-bedroom houses at 900. We would be, come on. Oh, wait, I'm looking at the wrong thing. That's what it is. There we go. 2020. So a 10% fall would take us to 2020. And if we go even further back, that's, around about here too. 2017 levels. Okay, so let's just say that. We'd be going back to 2017 levels, 10% fall. Still a far way to go before we get anywhere close to, affordable housing. Was 2017 housing considered affordable? But Michael thinks 10% is nonsense. So, if you're keeping up with the financial media, you couldn't miss the forecast of property price falls ahead. And it's no longer only the perpetual property pessimists, those who have been getting it wrong all the time, that are suggesting this. It's now some of the regular media commentators and the bank economists. Well, here's the thing. We've heard the bank economists and the RBA. Remember, at the beginning of this, they were projecting falls. The RBA even modeled a 40% fall in house prices. I suspect that was done for political motives, to encourage our conservative government to put on the me spend money hat and just go nuts. Anyway, of course, they don't all agree. Some are suggesting prices will fall modestly as the cycle slows down. Some think the fall will happen next year, and others believe it will occur in 2023 after another strong year of property price growth in 2022. So, okay, how they can project that. Here's the funny thing when you look at the modeling that people do to predict the environment in 100 years' time. They can't even, and part of that modeling is also economic modeling, guys. And they can't even model house prices in a year accurately. So, anyway. The ANZ Bank is forecasting modest price falls of 4% in 2023, while CBA is suggesting prices could fall by up to 10% in 2023. The average dwelling price is now $686,000, which means a 10% fall would wipe $69,000 from the values. So are they right? Is it too late to buy in the current property cycle? Should we worry about the value of our homes, that our homes will plummet? These are some of the questions I asked Dr. Andrew Wilson, Australia's leading housing market economist and chief economist of My Housing Market, in this week's Property Insider Chat. So, it's nonsense. Housing markets have generally recorded extraordinary price growth this year, driven by low interest rates, rebounding demand reflecting the interruptions to activity over the recent years, and a lower than average supply as well. You can't ignore the supply side impact on inflation, Michael. That's played a role. Sydney and Melbourne have led the charge over 2021, but growth, while still strong, has moderated over recent months. Most other capitals, however, continue to report boom time results. Rising affordability barriers and the satisfaction of pent-up demand will continue to act to moderate buyer activity, particularly in Sydney and Melbourne. Price growth, although certainly still positive, will be significantly lower over 2022 compared to the remarkable 2021 results. Recent predictions of 10% home price falls over 2023 based on forecasts of sharp increases in official interest rates are clearly nonsensical. Since 1987, Australia's capital city housing market has experienced only 3 years in which home prices have fallen: 2008, 2011, and 2018. And the price declines were clearly modest, falling just 4%, 4.1%, and 5.1% respectively. The last time the Reserve Bank of Australia raised rates, in November 2010, wages increased by nearly 4% annually. Higher interest rates were the catalyst for home price declines, with official rates increasing from 5.5% to 7.25% between 2006 and 2008, and up from 3% to 4.75% between 9 and 11. Price declines over 2018 reflected an APRA-enacted bank credit squeeze, particularly directed towards investors, that resulted in higher mortgage rates and restrictive lending conditions. The prospect of similar sustained increases in official interest rates to drive down home prices is currently clearly fanciful. The RBA recently yet again stipulated that given the latest data and forecasts, the central scenario for the economy continued to be consistent with the cash rate remaining at its current level until 2024. For wages growth to meet the RBA requirements for a rate rise by November 2022, the date predicted by those forecasting record price falls in 2023 would require an unprecedented surge in incomes over the coming months. With wage growth still at subdued levels despite the post-lockdown recovery and the jobless rate surging to a 7-month high, the prospect of wages growth quickly returning to the boom time levels last experienced more than a decade ago are remote at best. And the recent government announcement of a flood of 200,000 migrants set to enter Australia over the short term will sharply increase demand for current available jobs and housing. And of course, a quick return to high migration levels will again place upward pressure on the home prices in our still undersupplied housing market. And he's right there. He's right there. We need to make it easier for more stock to get on. And but there's everyone who owns a house doesn't want that to happen. You want the wealth effect, guys. You want the wealth effect. Well, I better go buy a $2 7-Eleven coffee now because of the wealth effect. I was actually talking to Rachel. She went and bought some shoes last night. And she went and spent $5 on a pair of shoes from Kmart, just some really cheap ones. I'm sorry we're living so poor. And she goes, no, we're not. I bought 3 pairs in all the colors that she wanted. So I somehow think no matter how much money we have, she'll still be buying the poor stuff and wearing it to death. See, that's the secret, lads. Find yourself a good cheap-ass wife. Anyway, I'm going to get in trouble for saying that. Another weekend of strong auction results. The late spring floor of properties for sale by auction is predictably continuing to push clearance rates down in all capital cities, although generally the results still remain in favour of sellers. The national clearance rate fell to a 3-month low, with only Canberra reporting a result above 80% over the weekend. So, Sydney clearance rates rise despite record November day. Clearance rates bounce back in Sydney at the weekend despite a continuing record flood of end-of-year auctions. Sydney recorded clearance rates of 77.2%, which was higher than the previous 76.3%, but lower than 80.8% recorded over the same weekend last year. A record 1,234 homes were listed for auction on Saturday, which was well ahead of the previous week's 1,075 and significantly higher than the 781 auctioned over the same weekend last year. The clearance rates for homes were 78.3% and units were lower at 74.7%. So record-breaking listings dent Melbourne's clearance rates. Melbourne's weekend auction market concluded November with a new record number of listings. The recent surge in auction numbers has predictably acted to put downward pressure on clearance rates that nonetheless continue to favour sellers. Melbourne reported a clearance rate of 69.8% on Saturday, which was lower than the previous weekend's 72.5% and lower than the 75.6% recorded over the same weekend. The clearance rates for houses were 70.3% and units were lower at 67.3%. So there we have Michael's take on housing prices not falling, guys. Well, what do you reckon? Frankly, I think he's made a sensible argument, but the issue is, even if it does fall 10%, it's still not going to be affordable. The issue is supply overall, long term. It's just going to get more expensive. And I can't see our governments, our politicians, or anyone really wanting to address it other than tokenistically. We'll have to see what happens at the next election. But guys, check out this video about auction clearance rates, where we actually looked at some data mining and found that, well, what they're claiming isn't 100% accurate. There's a it's more like the trend in rates because there's a bit of variation to it. Check out that video if you haven't. Take care, guys, and I'll see you next time. Bye for now.